She bought a Toronto condo for passive income. Now she's bleeding $2,000 a month. When Priya Sharma picked up the keys to her brand new Toronto condo, she felt like she had finally made it. At 34, she had spent years saving every bonus, skipping vacations, and living with roommates long after most of her friends had moved on. Real estate had always seemed like the safest path to building wealth, and everyone around her appeared to agree. Just get into the market, people kept telling her. Toronto real estate always works in the long run. In 2022, she bought a one-bedroom condo near the waterfront for $690,000. The plan seemed simple. She would rent it out, let the tenant cover most of the expenses, and watch the property appreciate over time. Passive income. That was the dream. By the spring of 2026, that dream was becoming a nightmare. It started innocently enough. Her first tenant moved out after accepting a job in another province. Priya wasn't worried. Finding a new tenant had always been easy, except this time it wasn't. Weeks passed, then another month. Every day she opened rental websites and saw dozens of competing listings. Buildings that used to have only a handful of available units now had entire pages of vacancies. Many landlords were offering incentives. 1 month free, 2 months free, free internet, free parking, anything to attract renters. Finally, after nearly 7 weeks, she found a tenant willing to pay $2,150 per month. The problem was that her expenses had changed dramatically. When she originally purchased the condo, her mortgage payments were manageable. But after renewal at a much higher interest rate, her monthly mortgage payment jumped to nearly $3,300. Then came the maintenance fees. The original projections from the builder had looked reasonable. Reality was different. Insurance costs increased, utility expenses increased, operating costs increased. The latest notice from the Condo Corporation showed her monthly maintenance fees had climbed above $650. Property taxes added another $300 per month. When Priya sat down with a calculator one evening, the numbers shocked her. Mortgage, $3,300. Maintenance fees, $650. Property taxes, $300. Total monthly costs, $4,250. Rental income, $2,150. Monthly loss, $2,100. She stared at the screen. Every month she owned the condo, more than $2,000 was disappearing from her bank account. Passive income had somehow become negative income. At first, she convinced herself it was temporary. The market would recover, rents would rise, interest rates would fall, everything would eventually balance out. At least, that was what she told herself. But every month, the losses continued. One Friday evening, she met her friend Melissa for coffee. Melissa had sold her condo the previous year and moved into a rental apartment. "Why don't you just sell?" Melissa asked. Priya laughed. "I wish it were that easy." She opened an app on her phone and showed Melissa several recent sales in her building. Comparable units were selling for substantially less than what she had paid. Some owners were accepting offers they would have considered insulting just a few years earlier. Inventory seemed to be everywhere. Buyers were scarce. Sellers were competing against dozens of nearly identical units. Even if she sold, commissions, legal fees, and lower prices would likely wipe out a significant portion of her equity. She felt trapped. Keep the condo and lose money. Sell the condo and lock in losses. Neither option felt good. Then another letter arrived. This one came from the condo board. A reserve fund study had identified several future capital projects that would require additional funding over the coming years. The letter wasn't announcing a special assessment. Not yet. But the possibility was clearly there. Priya suddenly found herself researching topics she had never paid attention to before. Reserve funds, building envelopes, elevator modernization, mechanical systems. She discovered that maintenance fees didn't always stay the same. Sometimes they rose substantially. Sometimes owners received unexpected bills running into thousands of dollars. The stress followed her everywhere. At work, she found herself staring blankly at spreadsheets. At night, she refreshed rental listings and market reports. Weekends became financial planning sessions instead of time with friends. The condo occupied her thoughts constantly. Ironically, she rarely even visited the property. One afternoon, she drove downtown to inspect the unit after the tenant reported a minor issue. Standing on the balcony, she looked out at a skyline filled with cranes and glass towers. When she first bought the condo, those towers represented opportunity. Now they represented competition. Thousands of similar units, thousands of investors, thousands of owners trying to make the same numbers work. For the first time, she questioned the assumptions she had made years earlier. She had spent so much time focusing on purchase price and future appreciation that she had barely considered cash flow. She assumed rising values would solve everything. But markets didn't always move in one direction, and when they didn't, the monthly numbers mattered a lot. By the end of May 2026, Priya made a decision. She wasn't going to panic sell. She wasn't going to pretend the situation was fine either. Instead, she created a long-term plan, reduced unnecessary expenses, accelerated debt repayment elsewhere, and accepted a difficult truth. The condo was not producing passive income, at least not today. It was costing her more than $2,000 every month. As she updated her budget that evening, she looked back at the spreadsheet one last time. The numbers were uncomfortable, but they were honest. Years earlier, she had purchased the condo believing real estate automatically created wealth. What she learned in 2026 was far more important. A property is not an investment because someone calls it one. A property becomes an investment only when the numbers actually work. And every month, her bank account was teaching her that lesson the hard way.